okay, if you have, when there are revenues, not all the revenues are collected, you collect the money at the same time, right? You are collecting some money later. Okay, so therefore you have credit involved, credit sales. You have debtors involved, right? Due to that revenues and the cash inflow may not be the same, right? At the same time, sometimes, okay, that will be a simple scenario. And why not all the expenses are cash outflows? Say not all the suppliers and the consumer consumption is not paid in the same month, because you have creditors. Certain things, their expenses incurred in the current period, but money goes out in the next period. Say your electricity you are consuming this month, so that is an expense for this month, but the electricity bill you will be getting at the end of the month. So the money goes out in the next month, right? So those are accruals. I said debtors, sorry, creditors, suppliers, and then you have accruals, and then we also have what we call prepayments. So like that there are prepayments if you are making advance payment, right? So don't think of too much of technical things. It's not a part of it, but this is a little idea. So therefore there are numerous operational reasons, right, which contribute to a difference between the income statement and the cash flow statement. Credit sales, cash sales, credit sales, cash purchase, credit purchase, prepayment, accrued payment, all those things are there. Got the point, right? So therefore there are lots of, we can call all these different types of reasons. There are operational reasons, operational factors that contribute to the difference between the income statement and the cash flow statement. Okay? This, we can say there are differences in the operational cash flow. This includes the depreciation as well. Like, because when you, okay, we come to that later. Okay, depreciation, you know what depreciation is, right? When you buy the machine, plant or equipment, something like this, you are incurring certain expenses, right? That expense, even though you do the incurring of expenses in a particular period, but that expense is not fully consumed. When you buy a printer cartridge, that printer cartridge may be consumed in the same month itself. So that the thing that you buy gets consumed in the same period. But when you buy the printer will be consumed over a period of time. So therefore, when you buy a printer cartridge, you can consider that entire amount as an expense. But when you buy a printer, you can't consider the entire cost of the printer as an expense, because you are using that over a period of time. So therefore, what we will do is we will pass that cost of the printer in the balance sheet, and every year, every month, depending on how many months that you are going to use the printer, small amount is taken out and put that as an expense. That is what we call the depreciation. That goes into the expense. But even though that you consider that as an expense, you are not actually paying that. You pay when you purchase the printer. So therefore, even though depreciation is an expense, it is not a cash outflow. Okay? So therefore, in addition to that, you have what you call the depreciation as well. So these are the operational reasons which makes the income statement and the cash flow statement different from each other. Is that clear? Right. Not only that reason, what I told you just now, buying a machine or an equipment or a vehicle or a plant or something like that. Right? You buy something. Is it an expense? No. We said that that's an asset. Yeah. We call that an asset. So then it is not an expense. Right? But when you buy something, you pay money and get it, but that is a cash out. You sell one of the old used vehicles that you are using. Right? And that is not a revenue. Right? That's not a revenue. Because that is saving something that you already. But there's a cash income. Right? So therefore this we call the investment related reason. When you make an investment, there can be a cash outflow, but that investment not an expense for the particular period. Get it? Or when you get rid of an investment, diversify, you sell some of the shares or investment where it is going to be captured. So these are what we call investment related cash flows. Investment related cash. These are operational factors. Your income statement and the cash flow could vary. Your investment related factors, your income statement and the cash flow statement could vary. Is that clear? Not only that, let us say your company get a loan. What happens? Your cash coming in, cash inflow, right? But is it a revenue? No, it's a liability. So therefore, that is when you get a loan or your company issue shares. What happens? Money comes in, but that's not a revenue. Or your company settles the loan. Money goes out. The interest will be an expense, but the loan settlement is not an expense. So we call them financing related cash flows. Okay? So basically both income statement and the cash flow statements relate to a particular period, but they are not the same. They differ from each other due to three factors: due to operational cash flows relating to day-to-day operations, due to investment related cash flows of the type that I mentioned, and due to the financing related cash flows that I mentioned here. Okay, so those are the factors that contribute to the difference between the income statement and the cash flow statement. So another 10 minutes we can wind up, right? Okay, is that clear? Now let me ask you a question. Now why do we prepare this income statement, balance sheet and the cash flow? Happening, but who uses that information? Tax. What else? Shareholder. What else? What sort of decision makers? Board of directors. Good. Sorry? Management. Okay. Media. Right. So there are so many parties who use this information. Right. Okay. Now if you look at that, yes, you can mention, say, shareholders probably. Shareholders. These are the not a individual small business type of environment. We are talking about corporate. We are large number of people who listed company, they are investing in this company, and they are not engaged in day-to-day management of the business. So then they need to get this information about what's happening in the organization. So then this income, this financial statements only, you will be getting all that information, right? So you get the shareholders who will require to get that information, and then the company may get engaged in different types of borrowings, right? Get bank loans and various other leasing facilities and things like that. So whenever they give these financing facilities, they need to ensure you are giving these advancements to a solid company where they can recover, they have the cash flow ability, they have profitable enough, right? So then that is the lenders are interested. Who else? Okay. There are government agencies, right? Government agencies, like say for example, it may be the BOI, customs. You can even say inland revenue. Like that, there are various parties related to the government who will be interested about this information. Okay. Who else? Auditors. Okay. We'll just park it somewhere. Yes, we'll park that term somewhere else. Where do you write it? Auditors. Right? Who else? See, sometimes the customers, don't the customers want that information? Do your customers require this information? What sort of instances?
Let's say you want to make a deposit in a financial institution, you want to see how
So if you want to make a deposit in a financial institution, bank or a finance company, so then as a customer you are worried about the financial health of that company. You are going to take a life insurance policy from an insurance company, you are going to be worried about that. Or if you are going to buy a long-term assets, that is a vehicle or something like that, you want to know that is a sound company. Or else you want to buy a machine or equipment which requires spare parts and after-sales service, then it would be required. And if it is a large B2B transaction where a large apparel vendor, retail company buying say 30% of their requirement from a supplier, so then as a customer they will be interested, right? So therefore customers are interested. But when you buy a bottle of Coke or when you buy a piece of soap or a pen or a pair of specs, you may not be interested. But then the customers are, shareholders are interested, lenders and the capital providers are interested, customers are important, various government agencies are interested. Who else? Now sometimes there are trade associations. There are trade associations that will be interested about this information. When you say trade association, there are plant association, apparel manufacturers association, like there are various associations that will be interested about various authorities, then that will be interested. And then also there will be regulatory bodies who will be interested. Who are the regulatory bodies? Say central bank is interested about the banks and the financial institutions. And then TRC.
In what context, the regulatory bodies would be interested in?
They say, for example, now regulatory body, central bank has a different role. Central bank has a role to ensure that as a public, they have found, they raise public money as deposits. So therefore, somebody will have to give that assurance that they manage good practices and it's not too risky to park their money with on this company. So therefore, that assurance, to give that assurance, central bank would like to monitor their financial performance. So therefore, to give that sort of a, they don't give a guarantee, but some sort of an assurance that yes, we watch them, and if there is anything not right happening not quite right, so give that warning signal, they would like to have that. Similarly, insurance companies, insurance board is there, so they raise public funds in the long-term life insurance plan, so they public will have to protect. On the other hand, something like TRC, they will be interested about the various practices and manipulative pricing and things like that, and even the gas and utilities, they are regulated because these are important products and services, but whose pricing margins they have to monitor because they can be exploited, right? Due to various reasons, sometimes if they are sort of monopolized organizations, they know they can be regulated because otherwise they can exploit the markets, right? So these are trade associations, so central bank, TRC, like that. So shareholders, lenders, customers, trade associations, and then of course you have, other than that, your potential investors, especially in large corporates, like there are investment funds and people who are individual investors. There are lots of parties who will be interested about looking at this. Those are this part. Now, all these parties I have mentioned, there is something common. What is that? All these parties, these are not the people who are running the business on a day-to-day basis. Right? They are not the people who run the day-to-day basis, but they will need this information because they have various stakes on the organization. So we call them external stakeholders. These are the external stakeholders of the organization. Right? And then when you think of a shareholder, shareholders also from corporate sense, shareholders are not in the day-to-day management of the company. And they appoint the board of directors, and then it's the board of directors and the executive team only who is going to manage this. Right? So therefore, they are considered. Now tell me, other than this, now we spoke of external stakeholders who will mostly use this financial accounting information that is there in the organization. Okay. Now tell me, what are the other accounting related information reports that you get from your organization? Other than this financial accounting reports, what are the other information reports that you get in your organization? Anything else that you get from finance department other than this? Yes.
I'm not sure about it.
What about you? Say, by what about the company budgets? So periodically, the company is in the budget, because there's an annual budget that is also happening within the organization, right?
But is it available for external stakeholders?
No, now we are not looking at this. Now what I'm saying is, other than this, what are the other accounting related information that is generated in the finance and accounting department? So budget is one, and then also when you have the budget, and then subsequently you will have at the end of the month and quarters and the year, you have various performance reports. Different types of performance reports, whether the respective division segments or the SPUs or whatever the band units have achieved their planned expenditure and revenues and the profits and the margins and the targets. So this is budget versus actual comparison, right? And then what else? Then also you will have what you call product and service costing. The manufacturing organization should know what it costs you to produce a particular product or a batch of products. The garment manufacturer should know what it costs you to make a particular garment. The furniture manufacturer should know what it costs them to make a particular table or a chair or a wardrobe or something like that. Right? So we call that product. Even though you use the term product, it can be a product or a service. The hotel should know what it costs to give a banquet buffet, right, or a cocktail menu, right? So we may call this product service costing. That is also something that is happening within the finance. Okay, and then also you have pricing related reports. What sort of pricing mechanism that you have? How do you price your day-to-day orders, regular orders, made to orders in certain types of industries, or when it is a tender or a special order, so like that. This pricing related reporting and the reports and the analysis is also something that is generated within the finance department. Okay, what else?
This is a different question. I don't know if it's related. Where do petty cash fall?
Petty cash is also actually, it is part of your financial accounting part. So it comes in the recording of transactions, recording and summarizing of transactions. So it is actually operational aspects, your debtors management, your petty cash management, all that is actually financial accounting related. Of course, certain reports relating to the petty cash can come into outside the financial accounting system, right? But in terms of record keeping, how much money you have taken out and where you have spent and whether you have accounted for that properly, that is all part of the information recording capturing mechanism, right? And then what I said is, when the company is making different investments, right, you want to see whether it is investment is a worthwhile thing or not a worthwhile thing, right? So therefore we have what we call investment appraisal or investment evaluation, right? What else? Yeah. We can say various types of the performance reports, which could include all that. And then you will have various KPIs, key performance indicators. Just give me a minute. various key performance indicators. Okay, we have various types of key performance indicators. These key performance indicators could be about your production flow, your machinery utilization, material wastages, the labor efficiencies, labor turnover, or if it is to do with the showroom, how the square space is utilized, the customer walking to the showroom and the per square foot sale, per square foot margin, etc. There are so many things, and what are the cost of operating the sales force and what sort of contribution they generate. All these, there can be so many different key performance indicators within the different operation areas. Now there are so many other different types of reports that are generated in the finance department. What do you call this accounting report? This accounting report we call financial accounting report, and these accounting reports, what do you call them? We call them management accounting reports. You call them management accounting reports. Right? This income statement, balance sheet, and the cash flow statement, these are our financial accounting reports. Whereas all these other reports that we generate in the organization are management accounting reports. Okay? Right. Now, who makes use of these management accounting reports?
Internal stakeholders.
Who are they?
Management.
Okay, company, managers, executives, staff, all these different categories of people who are within the organization. They will be using this information, so you call them internal stakeholders, and you call them internal stakeholders. So you have external stakeholders who use the financial accounting information, and then internal stakeholders will be using the management accounting information. Okay? And why do they need this information, the internal stakeholders?
To make decisions.
To make decisions. What else?
To assess the financial health.
To assess the financial health. So we may say it very broadly, an organization needs to do certain types of planning, that is long-term planning, and the long-term evaluations, and then the short-term annual planning, that is the budget, right? So therefore, and then when you before you execute the order, your product costing and how to price that product, all that. So therefore, you need this required management accounting. You need information for planning purposes, right? And then when you have this plan, you need to compare your plan with the actual and see whether you are heading in the correct direction, right? Your performance reports are your variance reports do that. What was your budget and what is the actual, where you have deviated and why you have deviated. So that is we will be looking at. And your pre-costing before you accept the order, what you expected the order to be, order profitability to be, after you execute that, what it is. What were your KPIs and how a particular division has performed, expected to perform within certain KPIs, but how they have actually performed within certain KPIs. Now that is what you are doing is actually controlling, right? You plan and then you to ensure that you control according to the plan, right? And then if anything is not happening properly or if anything is to be improved, so then you make certain decision making. Okay? So basically you would require management accounting information for planning control and decision making, and sometimes we bring another dimension to this, that is performance evaluation. Right? It is not just the control part of it, but you see whether things are going in the right direction, and then if a particular division or a person or a team or a segment is doing well, you recognize, reward them and put more resources, and if another segment is not doing so well, so you may take out resources and you may restructure, do various things. So that is performance evaluation. So then that is the other part of the story. Right? So that is the other part of the story. That is management accounting. So this is why financial accounting, this is what the financial accounting does. Right? This is the role of basically financial accounting, core role of financial accounting, and what it includes is income statement, balance sheet and the cash flow statement. That is financial accounting. Who uses that information is your external stakeholders. And then you have management accounting information. This is management accounting information, and that is for the internal stakeholders who are within the organization, and why they need this information is the planning, control and decision making purpose. Right? Having said that, what is the role of auditors? Then why do you have the auditors? Where do they fit in? Are they internal stakeholders or external stakeholders? Sorry? They don't belong to any category. Basically, the role of the auditor is basically you have the financial accounting statement, and organizations are owned by the shareholders who will not be getting involved from corporations, who will not be getting involved in the day-to-day management of the business. So therefore, they appoint the board of directors who take the responsibility of executing what the shareholders want on behalf of the shareholders, and they appoint the CEOs and the management team, and they will run it. And when the operation is running, they do various activities. But then when that activities are reported to the shareholders, we need to ensure that what happens within the organization is properly captured and communicated back to the shareholders. So therefore, their role is to ensure that whatever the transactions that happens within the organization are completely and accurately captured in the accounting system, and then the financial accounting statements that are prepared will reflect what we call a true and fair view of what is happening within the organization. This is the representative of what is happening within the organization. So that is the role of auditors, right? So therefore, their role is actually supporting the external shareholder role, but that is the role of external auditors, right? That is the role of the external auditors. And then you also hear of internal auditors. What do they do? These the internal or external auditors, they ensure that what happens within the organization is rightfully captured and reflected in the financial accounting statement. What is the role of internal auditors? Are they the same or are they different rates?
They're hired probably by the top management who are involved with the organization just to make sure everything is going okay.
Just to make sure everything is going on well, broadly speaking, but their role is actually an organization, when an organization operates, it should have a proper governance, responsibility allocation, accountability framework, not only within the organization, within and outside the organization. So there has to be a proper responsibility and governance framework, right? And then a risk assessment, and based on that you should ensure you set down policies, procedures that will ensure that the shareholders will achieve their objectives, and then based on that they need to do various checks and verifications to see that you have proper, you first make an assessment of vulnerabilities and the governance framework, and then you lay down the proper policies and procedures, and you ensure people stick to that and do that or everything according to the prescribed procedure. part of that, but it's a very much bigger, broader framework. Within that framework, that all what I described will be coming in, right? So that is the internal auditor. Those are the internal auditors. Mainly, their role is the internal part of it. They are more towards the because of the base of the company risk and the internal governance. Okay, right. I think we take quite a lot of time. So with that, we will bring this lecture to the end. Okay, and then next week we will be continuing with the same topic and start on the new topic that we are going to discuss. And meanwhile, on this book, we still haven't gone to the real depth of it, so it's just the starting thing. But this introduction chapter, right? You can read the first couple of pages, and depending on the time that you have, actually, you can read the first chapter. It's not the first chapter actually. Introduction chapter 2, right? On the printed book it's chapter 2, so you can just read through this. Read the first 2-3 pages more carefully, and completely read the entire book, entire chapter. Okay, so that's your. Okay. Any clarification? Are you okay? Right. So it's going to be. We have a lot of numerics and the computation coming in, but just the starting point, and let's see how things progress. Okay. So we'll call it a day then. I need